Hello, this is Brian Shannon from AlphaTrends.net. Today is Thursday, the 17th of January, 2007. The market's closed, and it got smashed again here today. The Spiders lost $3.65, or 2.66%, as it seems the buyers have just completely given up on this market. And now we're right down to these levels that I've been pointing at since about November of last year that might potentially act as support for the market. Now, might and potential are the key words here. These highs from April of 06 were right at about 132.80, and then you've got this trend line that had been hit numerous times between 2004 2005, and those are coming together right here at about 133. So this is a potential area of support for this market, but it does not mean it's time to buy, not until we see signs that the market is starting to bottom and show some support. And clearly, looking at this 10-minute time frame here, there are no such signs. You can see that the 138 level, which cracked yesterday, and then they tried to bring it back above there, really led to a greater sell-off. And in particular, once it confirmed it again with another lower low this morning here at 136, it was just pretty much a complete give up all day long in here. And no signs of any buying coming in, even late in the day. If you look at the daily VWAP, they closed pretty much right near those lows. I don't know if they're waiting for Bernanke to do something instead of say stuff, but this market is clearly just in a bear market. And for months I've been saying that it's best for day traders, or if you're going to trade longer term positions, that you know, the short side is where the action is at. Personally, I don't ever feel comfortable holding long or short positions for a long period of time. I think again that the you know, the play has been in these inverse ETFs. And you know, one thing that I was looking at earlier today as well is that we can look at that trend line and say, well, it's coming down towards support. If we take a look at a VWAP, and even if we go to the monthly time frame, if we say we take the lows of 2002 right here, and we draw a line straight across, we can see the average price that the S&P 500 has traded at since the lows of 2002. The average price has been at about 130. If you took it just from, for instance, 2004 and went forward, you see we're right at about that level. If you take it from 2005, you can see that basically 2005, 2006, and 2007, the average transaction occurred at a higher price than where we are right now. So a lot of people are beginning to really feel the pain here from this bear market, and that's you know, that's why I think we're seeing such give up in here. But the one thing is, we haven't seen the panicky volume yet. Perhaps that comes tomorrow with options expiration day. But clearly there's just bigger problems for this market, and the signs have been there. You know, again, look at that video that I posted back in November that said, where I was talking about the potential for a much longer term damage being done as the market was over in this area. So the semiconductors back below 350, no signs of any bottoming in this group right here. Maybe it's trying to hold near that 350 level, but again, that's not a reason to do any buying. You know, this Intel, again, closed down again today, and no reason to be involved in any of these stocks that are getting hit like this. The people that come on and say, you know, Citigroup is a great buy, let them buy it. But the stock is in a downtrend. 50-day moving average is declining. These stocks are guilty till proven innocent. They are damaged goods. They're gonna there's stocks correct two ways. One is through price. We're seeing that. The second is through time. If they don't scare you out on the way down, they'll typically wear you out. These things do not bottom quickly. Let the Saudis buy them. Let whoever buy them, but stay away from these stocks. The IWM just continues to be the leader to the downside, although it was down 2.5% today. This is the group that originally had us concerned when it cracked this trend line back months ago, and perhaps it's heading down towards this this level in here, which is actually at about 66.5. But again, no signs of a bottom in here. A lot of people are tempted to rush in here and try and buy these markets. And if you're going to buy them, you know, and if you're trying to pick a bottom, these bottoms, again, there's going to be good trades to the upside, but those trades are usually, they occur very fast and they fail very fast as well. So just stay away from them. Defense wins the game in here. And we broke that 68.50 level that we've been looking at, 68.60. So again, we've got lower lows and lower highs, and again, like I said yesterday, these consolidations in a primary, typically resolve themselves in the direction of the primary trend, which is obviously lower here. If you take a look at this, we could even say, well, this is a descending triangle in here where we had support at 68.5, and the height of that pattern is up towards about 72. So that would give us 3.5 points of downside from that 68.5, which would give us a price objective down near about $65 a share, which is actually way down here. So it doesn't mean the market will go there, but these are always just potential levels of support. I think you got to look at these 2006 lows first as that potential area. And again, the S&P 500 is at a potential level of support. But when you see a potential level of support, it doesn't mean buy. It means go, shrink your analysis to the shorter term time frames and look for evidence that it is finding support there. There is zero evidence that this market is finding any support right now. The only thing you can do is put these trend lines on here, but once we take those away, we're left with nothing. We're left with just a bunch of possibilities. If there's enough people looking at these trend lines and the sellers decide, hey, this thing's getting oversold, I'm going to stop selling, sidelines cash starts coming in after shorts begin to cover in here, then maybe it starts to become a self-fulfilling prophecy. However, there's no signs of that yet, so if you're getting itchy to buy, just wait. Patience will reward you in here, and cash is a position. Look at all the people. I mean, the S&P 500 is down 10% this year, and it's only January 17th. There's going to be a lot of opportunities to make money later on this year on the long side. There always are, even if we're in a downtrend overall. But bottom line is you got to have some cash available to take advantage of those opportunities, and buying each time this market hits a new low is a sure way to make sure you don't have any cash available. The NASDAQ 100, this 46.50 level, broke yesterday and closed below it. They tried to push it back up there again today. That failed. This market on a percentage basis was only down 1.4%, but it closed right near the lows, and there's nothing encouraging on any of these time frames either that would tell us that we should be looking for a bottom. The MACD does continue to diverge, but again, only price pays. That's the only thing that should tell you when to buy or sell. You don't buy because of a VIX or because of a Bollinger Band or a moving average. Those are all reasons to take a closer look at. Maybe there's the potential for a turn somewhere in here, but again, right now there are zero signs of any buying on any of these time frames.